Hi everybody. On the 7th of April 2026, the Income Tax Appellate Tribunal in Mumbai pronounced an order that wiped out a tax exemption of 4 crore 28 lakh 31,578 rupees in a single ruling. The taxpayer was not a first-time investor. She was a chartered accountant. She had sold land. She had reinvested in a residential flat. She had ticked every box she thought existed. Result? The entire exemption gone, not reduced, not partially disallowed, gone. And here is what is absolutely mind-blowing, guys. The legal principle that destroyed her 4 crore exemption is not a new rule. It has been sitting inside Indian tax law since January 2019. And there are very strong reasons to believe that thousands of investors across India are walking straight into this exact trap as we speak. So the question is, how on earth did a chartered accountant lose a 4 crore rupee exemption while believing she had done everything right? What exactly is this allotment date trap that is now sitting inside Section 86 of the new Income Tax Act 2025? And most importantly, what are the legal lessons that every business owner, every director, and every HNI in India needs to learn from this case study? They make the same mistake. Stay till the end and I will not just walk you through the case, I will show you the exact contradiction inside the new tax regime that is converting a perfectly legal tax saving strategy into a self-destruct button. And I will give you a free compliance checklist to audit your own exposure. Let's start from the basics. When you sell any long-term capital asset in India, shares, gold, commercial property, land, anything, the government gives you a deal. Reinvest the gain into a residential house and the tax disappears. This is what the law calls a reinvestment exemption. Under the new Income Tax Act 2025, it sits in Section 86. But the exemption only works if the new house is purchased within 1 year before or 2 years after you sold the old asset. And the most important word in that entire sentence is purchased. Let's say there is an investor named Ravi. In January 2024, Ravi sells unlisted shares for 10 crore rupees. In December 2024, his under construction Mumbai apartment finally gets registered. Ravi tells himself, my purchase is December 2024, my sale was January 2024, my exemption is bulletproof. But here is the catch. Ravi paid his booking advance and got his allotment letter. In the eyes of Indian tax law, Ravi did not purchase his flat in December 2024. He purchased it on the day he got the allotment letter in 2020. And 2020 is 4 years before his 2024 share sale. The window is 1 year before. Ravi has missed it by 3 years. Result? 10 crore of capital gain becomes fully taxable. The exemption is dead. This is the allotment date trap. This is not a new rule. The Bombay High Court ruled on this in January 2019 in CIT versus Vembu Vaidyanathan. The court relied on two CBDT circulars, Circular 471 from 1986 and Circular 672 from 1993, and held very clearly that for under construction property, the date of allotment is the date of acquisition, not registration, not possession, allotment. The Income Tax Act may have been replaced in 2026, but the CBDT has confirmed that all old circulars continue to apply under the new act. Circulars 471 and 672 are still alive. Vembu is still binding. And on the 7th of April 2026, the ITAT applied this exact rule to destroy a real woman's real exemption. Her name is Yamini Anant Gawande. In July 2012, Yamini sold a plot of land. The long-term capital gain was 4 crore 82 lakhs. To save tax, she claimed an exemption of 4 crore 28 lakhs under the old Section 54F by reinvesting in a new residential flat costing 8 crore. Conveyance deed registered 25th of February 2013, within 2 years of her July 2012 sale. Textbook compliance. But the assessing officer pulled out one document, the booking receipt. First advance payment 1 crore 26 lakhs. Date 19th of November 2009. Your purchase date is 2009 and 2009 is 2.5 years before your land sale. You are outside the 1 year backward window. Your exemption is denied. The ITAT agreed. 4 crore 28 lakhs of exemption vaporized. Now let me show you what this looks like for a promoter today with actual money on the line. Take Ravi from earlier. 10 crore capital gain. Allotment date 2020. Sale date 2024. Window breached. 12.5% LTCG on 10 crore is 1 crore 25 lakhs in base tax. Add surcharge and education cess on top. Then comes section 270A, under-reporting penalty, 50% of the tax payable, that is another 62.5 lakhs. We are at 1 crore 87 lakhs and counting before surcharge. But the cash bill is the smallest part of the problem. Section 281B of the Income Tax Act gives the department the power of provisional attachment during appeal. Translation: while you fight the case for 3 years, the department freezes your bank accounts, blocks your demat, puts liens on your fixed deposits. If you are a director of a private company, Section 323 of the new Act, the successor to Section 179, says that when tax cannot be recovered from the company, the directors are jointly and severally liable in their personal capacity. The department bypasses the corporate veil and attaches your house. If the AO finds that the allotment letter was deliberately backdated or manipulated, this becomes a willful attempt to evade tax under Section 478, which is a scheduled offence under Part A of the PMLA schedule. Once PMLA enters, Section 19 lets the Enforcement Directorate arrest a director on reasons to believe. Bail is governed by the Section 45 twin conditions, which are notoriously hard to clear. And in case you were thinking, fine, I will move the asset before they catch me, the SAF EMA Appellate Tribunal in Ayush Kejriwal versus Directorate of Enforcement ruled that where assets from the offence are untraceable, the ED can attach property of equivalent value. Property you bought before the offence, property you bought with completely legitimate money. The Supreme Court in Vijay Madan Lal Chaudhary upheld the broad framework. The pre-offence domestic property question is still being litigated in the High Courts, but the law on the books today gives the ED that lever. If you are a CXO with a real estate SPV, this is the cascade. But here is where it gets absolutely mind-blowing. Right now, in 2026, your CA, your top-tier law firm, your Big Four advisor, is telling you to do something that walks you straight into this trap. Why? Because of the 23rd of July 2024 grandfathering cutoff. After July 2024, the LTCG rate on real estate dropped from 20% with indexation to 12.5% without. For properties acquired before that cutoff, you can choose the better treatment. So advisors are telling clients, dig out your old allotment letters, prove your acquisition date is in 2020 or 2021, claim 20% with indexation, save tax. And the moment you do that, you have handed the assessing officer the exact weapon needed to destroy your Section 86 exemption. You cannot have it both ways. If your acquisition date is 2020 for the Section 86 argument 2, you cannot tell one tax officer your house was acquired in 2020 and another that it was acquired in 2026. By winning the indexation battle, you lose the exemption war. This is the contrarian insight that the Yamini Gawande case has crystallized. It is settled law from 2019. But the simultaneous activation of the indexation grandfathering option and the Section 86 window means thousands of investors are walking both paths at once. Unaware, they are heading towards a collision. This is also why CREDA and NAREDCO have been sending intense representations to the Ministry of Finance. HNIs are refusing to deploy liquidated equity gains into under-construction real estate. The tax architecture has turned hostile to the very transaction the industry depends on. So what are the lessons we need to learn from this case study? Lesson number 1. While ordinary taxpayers fight tax battles in isolation, sophisticated taxpayers fight a portfolio of battles in parallel. Before you lock your position on any one claim, like indexation grandfathering, model the impact on every other claim that depends on the same fact. In this case, the same fact is your acquisition date. It has to be consistent across the indexation argument, the Section 86 argument, the holding period, and the cost basis. Inconsistency is what gives the AO his weapon. Lesson number 2. Always assume the assessing officer has read every Bombay High Court ruling from 2019 onwards and every CBDT circular from 1986 onwards. The law does not become real on the day a court delivers a judgment. It becomes real on the day a tax officer learns to apply it. The April 2026 ITAT order is not a new rule. It is proof that the department is now operationally ready. And last and most importantly, every legal landmine in India is also a legal opportunity, but only for the person who reads the actual statute, not just the headline. The smart play is to map your acquisition date with surgical precision, run the math under both date scenarios, and pick the path that produces the better after-tax outcome, even if it means sacrificing indexation to preserve the exemption. In some cases, the investor who accepts the registration date and gives up indexation walks away with materially more after-tax money than the investor who fought for indexation and lost the entire exemption. The investor who has done that math has already won. To help you do exactly that math, the link in the description has the full LTCG registration date time bomb audit. 6 audit points. The complete section mapping table from the 1961 Act to the 2025 Act, and a date consistency template you can run across your own portfolio in one sitting. That's all from my side for today, guys. If you found this analysis valuable, hit the like button. And for more such deep dive case studies on Indian tax, corporate and constitutional law, please subscribe to the channel. Thank you so much for watching. I will see you in the next one.